Good morning, everyone. Welcome to our 2023 Winter Forum. Sorry for the slight delay due to technical difficulties, but we are ready to kick things off. And just like usual, when we're in person, you get to listen to me for a couple of minutes before the guys come on to share all the good quality stuff that we have for you today. But to just go through a few things before we bring them on. For today's agenda, we'll be going through a Gentian update, some new things that are happening here at the firm. We'll go through a market update, talk about market corrections. Obviously, last year was a difficult year in the market. We'll go through the Secure Act 2.0 that was finally passed at the end of 2022. So we'll talk about what that might mean for you. And then we will go through some other financial planning ideas. Obviously, today's an important day. It's February 8th. What some of you might know is it's actual National Iowa Day. So that hits very home to Chris, I know, and some other people that are attending this morning. Also today happens to be Ryan's birthday. So if you have a chance to wish him a happy birthday, please go ahead and do that. He's very excited to be celebrating here with us this morning. Also, you may have seen the post that February happens to be a very busy month for Gentian in terms of work anniversaries. Actually, Zach and I had ours earlier in the month. Angie's actually this coming Friday, and Lisa's is this coming Sunday. So February is very busy for us. Also later in the month, Jenny will be celebrating her birthday. Some upcoming dates for events that we have going on. Next week, Wednesday, we have both our bi-weekly update, and we also have our February birthday lunch club. So if you haven't had a chance to RSVP for that, please do. Also, if you have a birthday in January and you missed, or March and you won't be able to attend and you'd like to come in February instead, you are more than welcome to do so. On Monday, February 20th, our office and the markets will be closed for President's Day. And then on Wednesday, February 22nd, we will have limited office hours as we continue our dedication to further improving our ability to serve you as we continue our improvement of professional development. So we'll have limited office hours that day. As a friendly reminder, on our website, if you don't get the bulletins or get them lost in the mail, we do have our events tab on the website where you can go ahead and RSVP for any event that we have coming up. You just need to go to the events area and then click on RSVP for the event you would like to attend. Some exciting news that hopefully you saw via email or LinkedIn or Facebook post is the Gentian Financial team was just named to the Forbes Best In-State Wealth Management Teams. And to give a little background on that, there are 205,000 financial advisors in the US. Less than 38,000 advisors and 8,000 teams were nominated for this award. Only 2,800 teams were awarded the award and only 47 in the state of Wisconsin. So very proud of everyone here, and we couldn't do it without the trust and faith that you as our clients put in us. So thank you and congratulations to you guys because you earned this award just as much as we did. Finally, you may be getting familiar with this by now, hopefully. We will have a QR code posted at the end. All you need to do is scan that with the camera app on your smartphone, and it will pull up a survey for today's forum where you can help provide us feedback so we can make sure we're continuing to improve these the best that we can. So that's it for me. Today, you're going to hear from Chris Doty, Ken Flannery, Zach DeBoer, and Mike Mann for some exciting things that are happening, and I will bring them on now.
Awesome, Peter. Thank you. And just to Peter, FYI, you're probably going to still want to do the form on your computer because the email didn't come through. But today, that's just a little technical item. But I want to go big. Going big is always great. It's beginning in gratitude. What I'd like to do, first of all, is have the entire team wave at you. If we can see everybody, you might want to make a noise each consecutively and wave, because I think that means you'll be on the front.
Good morning.
There you go.
Everyone.
Hi.
Good morning.
Awesome.
Good morning, everybody.
Good to see you all. Good to see you all. So we're all going to share our gratitude simultaneously. So I'll talk at once. Wait a minute. Hold on. I'm just kidding. I'm grateful today for a beautiful sunny day, for technology, for all sorts of things that exist here as well. What I'd like to do, though, is I'd like you to do one thing. Instead of necessarily talking about our gratitude, if you'd bear with me, I'd like you to pull out your cell phone. If you have a cell phone, and I've got something that we've done recently that we enjoy, and take out your cell phone, if you will. Take a moment, and I want you to text somebody that you're grateful for. Could be a daughter, son, friend. Just go ahead and text them, brighten their day. Say something to them, said, hey, I just wanted to let you know I'm grateful for you or something you've done for me. So I'm going to give you 60 seconds for you to go in and do that now. I'll do the same. All right. Well, thank you for humoring me with that. It's a wonderful thing as we like to spread gratitude. It kind of has a wave out effect. And we did this on Monday last week in San Antonio with a group. And it was fun to hear the responses throughout the day of people who just thought, are you dying? Are you okay? That was some of the first questions people had, which were amazing. But the nice thing about it, it gives you a moment just to stop and to send gratitude out. Not only will you feel better, but also somebody who you'll talk to or somebody who you're going to reach out to may have a better day because of what you just said to them. So I want to thank you for doing that with us and running through. A couple things, Peter, if we want to go to the next one. Thank you. Questions we're hearing from you. And these are awesome. If you start to look at this, this is just a great slide. So I'd like to keep this on for a couple of minutes. We'll hop to the next one as well. But these are things we're seeing from you and hearing from you. So how can we protect against inflation? That's a big one. What should I do with my cash reserves? We've got some great ideas there as well. How much longer will this correction last? Why do my bonds have a negative return last year? What should I do with my inheritance, or I'm possibly going to receive one? What might I want to do with that? Should I explore senior living? Am I still on track? And how is Gentian doing? These are 8 questions or so. There's many more that we hear, but 8 that are preponderant, things that are hearing pretty commonly right now. Gentian is doing great. We're adding a new individual. Thanks to your introductions. We got through last year in good shape, but we also remember we are planners. So we plan for years like last year as a normal part of our existence and what we do. This is a very, very important thing for you to understand, is that we practice what we preach. Some of the other things we'll discuss more as we go through the actual program today. The Am I Still on Track is very personal to you, and in many situations, when you sit down, we'll go over those as well. But I just wanted to address some of the different issues we're seeing right now as we begin to head into what looks like potentially a recovery year. But more importantly, going back to learn from what happened, not to lament them, but just to learn from those as well. Now, another thing we do as we go forward is, what's going on behind the scenes. That'd be the next slide, Peter, if we may. Thank you. So what's going on behind the scenes? This is something that I've always looked at, that if I have an advisor and I've trusted you to do something, I'd like to know what's going on. What are you guys doing when I'm not looking? So a few of the things you can see here we're listed as doing is reviewing portfolio holdings, reviewing the planning items that come out pretty much on a daily basis whenever somebody speaks, looking at the cash holding alternatives, reading for perspective, evaluating ways to kind of improve our deliverables, the things we give to you. Meeting with industry experts is another one. Many different meetings you'll hear about as well from Mike and Ryan in the group. Also, continuing education is a big part of what we do, and I call that getting better for you. We have that one day a month here in the office, and we'll often go to programs with which we can improve how we are for you as well as we move up. Now, a couple of different things as well. If we go to the next page, I just want to show you a review checklist. And this is something put together by Mike and Ryan and Zach as well. But it's a derivative of what we do even before one of your meetings. So in our review checklist, we may go over 3 or 4 important topics or points with you. However, what we're doing here is checking 20 or 30 or 40 different items you'll see here, just to make sure that you're set for your appointment, for the things you need for the next year, for the things you should have done for the year that you're in. And if there's anything we also need from you, it's a checklist to make sure we're prepared for the meeting in all, say, 90 positions that are on here. But more importantly, that we're going to address those with you during the meeting. It's kind of like if you've ever gone to a car dealership and you went in there because your brakes were squeaking a little bit and you got this checklist that had 94 points on it and you didn't even know they checked the muffler belt. I'm joking on that one. The muffler belt doesn't really exist, but I love bringing that one up. As you go through, though, there's all the things you didn't know that we were checking that we do. One more piece I wanted to bring up to you that's really important, and I'll maybe let Zach explain a little bit of this one. But we have a great center of influence group. Do you want to speak a bit on that, Zach?
Absolutely, Chris. Thank you for the introduction there. Just really wanted to quick say a go big, as well as just had the opportunity to take a little bit of time off, and anytime you have space and grace, you just have a great opportunity for gratitude and perspective. And I'm extremely grateful for each of you and what we get to do for you and the team that we do it with. So just extremely excited to share a few of these. Regarding the centers of influence, you might have heard us mention it a few times before. We constantly are screening and interviewing just like they would be part of our team of estate planning attorneys, CPAs, real estate brokers, bank lenders, insurance experts, even a few others in what would appear as unrelated industries, but have a good pulse of what's going on and that can potentially help you guys when scenarios come across. So we constantly screen, constantly interview them to make sure that we trust them first before we introduce them to you. And we met 2 weeks ago and really went through back and forth a few different ideas. In 2020, a big one that talked about on the insurance side that we didn't even really think about at first was just replacement costs of homes. So there's different things that come up that we just want to be able to bring up to you when scenarios occur. And recently, one of our real estate brokers actually specializes in helping people downsize. So trying to come up with different ideas and strategies when they come up for you and be able to share those people with you or share different ideas with you as well.
Awesome. Thank you, Zach. Yeah, we get a lot of information from them. And really, the more important thing is when we sit down, one of the first questions we ask is, what do I need to know from you for my clients about your area or industry? And it really helps us get a wider view of things we should be watching for you. So it's wonderful. Thank you, Zach, for curating it. And Ken was a great, he birthed that program as well, which is outstanding. So he since handed that off to Zach, and Mike helps us with those as well. So it's wonderful, wonderful program. But these are things we do to make sure that we're being wide for you, that we're looking at your entire plan. I wanted to go through that. Some of the things I also wanted to run through here as well is some of what we have on the continuing education. So I'll just give you a quick summary of each one. Elite advisors or master elite advisors with that slot is really going to understand tax law, qualified tax law, and we study case law. I mean, big, thick binders. I should have brought one for you, but we get to spend those on weekends looking at all the tax law that people have gone through, all the ways people try to slight the IRS. Academy of Preferred Financial Advisors is a wonderful program that is more about the practice, being most efficient, the best practices from top advisors around the nation. The Elite Wealth Advisor Symposium is run by the #1 advisor at Raymond James, but also 3 or 4 others as well. And it runs with just a plethora of different wonderful speakers and great learning opportunities. And the team often goes, Peter has attended that most recently. Strategic Coach is about spending some time outside the business to work on the business. And 2 or 3 of us attend those as well. That's with Dan Sullivan and Lee Brower. Empowered Wealth is also another wonderful program. It's about becoming a better human. And the Raymond James Elevate is a conference that we'll go to. Several of us will attend and bring back different ideas from, hundreds and hundreds of different opportunities and coaches, and more important, compliance and things we need to make sure we look forward to. So continuing education is also an important piece, but that leads us to the next slide. And before we start in this, I want to go through a couple of different items here. Really, the big question has been, will there or will there not be a recession? Right? How many people have heard that? If you look at this recession idea and what we've gone through here, really, I'm going to say it's been a year-long question people have asked, and the question's ridiculous. It's something we look back on to see if it's actually existed. A couple of things we've just seen as well. The labor market, in a surprise last week, added 500,000 new jobs. and they were expecting it to add 100,000. So what we're finding is that despite what may be a weak economy in some areas, it's very strong for employment. So employment inflation has been fairly high. We're at 3.4% unemployment as well, which my economics professor, F. Abraham, that's what he made us call him, by the way, back in college, University of Northern Iowa, said that when you're under 5%, it's trouble. It's too thin of employment. You can't find enough employees for work. When you're over 5, it tends to be a problem. So at 3.4, that's historic. So we're still having more and more of a demand for people. What might that lead to? That might lead to more artificial intelligence, and it might lead to more robotics, automating systems with humans, which humans right now are doing that don't necessarily need humans. We're going to talk more about artificial intelligence here as we get a little bit further. Very interesting as you go through. In looking at this recession, the media often will bring you ideas that require second level thinking. Now, remember, the issue with this is the media does not and cannot actually handle second level thinking. So what you have with this is they give you stories. You have to go and interpret them. So they just want to bring you a reaction. Oh my gosh, watch the next story. You have to go through it. And I look at this, there's a couple of things that have really helped you get through this and us, and that's faith, patience, and discipline. I mean, one of the questions people do ask us is, why are you so patient? Why are you so patient with what's going on? Well, because we studied this we studied the market, we studied the history, we studied with perspective, and it gives us the ability with faith, patience, and discipline to get through what's going on. What's really interesting about this, and I think this is probably last year, giving you some example of what last year was to, for instance, the NASDAQ. Last year, 81% of the NASDAQ at one point was down 20% or more. This is according to JP Morgan statistics. At one point, over 50% of the NASDAQ was down over 50%, lost half of its value or more. What's interesting about the S&P is that 56% of the S&P was down over 20%. Even worse was the Russell 2000, which 47% was the average correction in a stock in the Russell 2000. Small cap was hammered even further by empirical research. They reported that of the high growth companies that exist out there, 67% was the average correction of the highest growth companies in America, in the indexes. This was a depression. This was a massive correction. When you look at that, that means the companies that really have been leading the way were just abandoned, completely let go of. And so it's going to take a bit to recover from that. But after 13 years, almost 12 to 13 years of around 17% return, it's kind of a crazy one to hit a massive correction. We're down, in the 20s. But if you look at this was a secular bull market that we're in with a correction. If it's a secular bear market, there's a massive difference. So I just wanted to give a bit of perspective on my side, just from some of what we've seen in the markets. This may take some time to recover, but it's kind of an interesting one. I just wanted to give you some of that piece as well. Peter, if we can hop back onto the presentation. Thanks, sir. Appreciate it. This is one normally I let Ken do, but I'm going to do it today only because it's a timeless piece. This is like Lombardi or Wooden. Corrections are swift and visceral. They come without warning. Their length of stay is unknown. They're not pleasant when they're around. They leave scars on those who react poorly. They're temporary and necessary. They are vital to long-term return and essential to the health of a long-term bull market. So going through those, it's just what we've gone through. I want to give you all congratulations. You've all been through it. We appreciate it. We appreciate your patience and faith and discipline. Really, it's been a wonderful, wonderful time for you to get through. And what happens in times like these, this is the last part of perspective, and you see the birth of new companies that we don't yet know the name of. When you see people that go from Facebook, from some of these leading companies, they are now going to start the company that they always meant to, that will possibly be one of the biggest companies in the world in 15 or 20 years. These are the birthing grounds. These are the seeds that are planted for the next stage of markets. I want to offer that perspective because we often forget about it. We feel the unpleasantries of what are happening in inflation and all the different things we see going on now. But there's actually good that comes of it. So there's always two sides of this coin. Anyway, those are a few different items I wanted to start with before Ken can take over with the annual end of the world. I know I took your steam in that one, Ken. You love the market correction slide, but I just felt compelled to use it today.
Yeah, I think that's fantastic, Chris. No worries there at all. It's funny when we talk about market corrections that are swift and visceral. I just kind of came up with this one. When we see market rebounds, they're also swift and blissful on the other side of it too. So, we can come up with the different taglines for these, but those are very important. And if we go to the next slide, you'll be able to see the annual end of the world, which you've seen this. So in any of our planning reviews that we do with you, you probably could describe this slide to us maybe better than we can describe the slide to you right now. But really what you're looking at here is a timeless piece throughout history, goes back basically 40 years. And really what it shows is what the S&P 500, where it finished up for the year, which is the gray bars that you see there year by year. And then what happened throughout the year, which is the red dot. And so you can see here, if you go all the way to the right of the screen, you can see in 2022, which is last year, you can see that the S&P 500 finished down 19% last year, while at some point in time during the year, the markets were down 25%. So, this is an interesting slide when we look at this. I think it's also interesting if you kind of go back to the middle of the slide in the 2000 range, what you can see there is you can see that 2001 and 2, those were 3 tough years back to back to back. And there was a lot going on. Growth was really, growth companies were massively growing. You had Y2K, everybody thought the world was going to come to an end at that point in time. You had Twin Towers, you had a recession in there. There was a lot of stuff going on there. And that was probably the one that stung the most because it lasted the longest. When you go back to maybe a little bit on the right side of the slide, you'll see 2008, which is that negative 38% bar that you see there in 2008. At some point in time, during the year, it was down 49%. So we bring this up for perspective because Chris mentioned it before, is that these are the natural rhythms of the markets that we go through. We can never time these out. They show up unpredictably. And so as long as we know that they're going to happen and the history tells us they've been temporary, we're going to be okay if we act upon our financial plan rather than reacting to the markets. What I also find very interesting is that when you look at like security prices and how they fluctuate year over year, you'll notice that if you look at that, the outputs, the economic output and company profits, when those numbers come out, they don't fluctuate as much as the overall security prices of great companies do. So that just tells us one thing, that whenever there's people involved, which, money is an emotional thing, and people become involved, you're going to see the fluctuation of the markets much more than economic output numbers or company profits when they come out, which is really interesting. So that is the annual end of the world. You've seen that one before, but again, we are patient, you are patient, and you have a wonderfully diversified strategy. And that will really prove to be the test of all this and get us through these times that we're going through right now. The other one that you see here as well, if you go back to the slides, it's the annual end of the world, but on the bond side, on the fixed income side. Easy for me to say, right? But when you look at this piece, this is also a good portion of your overall hard-earned money that you have in your investment accounts. And we have seen something that we haven't seen in almost 50 years in the area of bonds. So the annual end of the world, we talk about the stock market and great companies. We also talk about it in the fixed income area and the bond area. You can see, if you go all the way to the right of the slide, you can see that the bond market was actually down. Now, there's many different areas of the bond market, but I believe this is the aggregate, if you will, kind of a mixture of the bond market. And when you see this, down 13%, bonds were down 13%. Now that shocked a lot of people because bonds are supposed to be very much a safety play for a lot of people in their minds, or a buoy, if you will. When things go down, the stock market goes down, bonds should hold us up. And we actually seen something different last year because the Federal Reserve was very aggressive in raising interest rates, and that's what we saw there. So something we haven't seen in a long time. This is one of the changes that we made in December of last year. You might have noticed a few changes in your investments. This is one of we actually went into this category for the strategy because of what happened and how much some of these bonds are very much on sale right now. So I know Mike wanted to add a few pieces here, so I'm going to skip it over to Mike. And Mike, feel free to add something.
Hey, thanks, Ken. No, I really appreciate this chart. I mean, taking a look at this is fascinating to me. We're talking that last year we had the worst year in bonds in just about ever. I mean, the majority of the people alive have not seen a year like we did. And I do just want to touch on what kind of happens with bond prices as interest rates go up, because that's a concept that, you know, we want everybody to kind of understand. So with inflation comes rising interest rates to try to control inflation. As inflation goes up and interest rates subsequently, new issued bonds are trading at much better yields than previous ones. So what does that do to the price? So the previous bonds that have a lower yield, those specifically are now worth less to the individual investor. They have to be sold at a discount because new issues, you can get a better yield with it. So because of that, the holdings that pre-existed in some of these mutual funds and just in people's portfolios in general, the value of those bonds were pushed downward. So what we were looking at, you know, back years ago when interest rates were at a low point, we looked at getting into an asset class called floating rate, which is what a lot of people have owned previously. And with that, that is one that has a short duration, meaning that it isn't affected so much by price movement because new issues happen often. And then they also have a variable interest rate. So they're able to adapt and go up. Because of that, we were able to make a change at the end of last year that Ken was alluding to earlier that was able to lock in some higher quality debt. And what that basically means is that investment grade bonds, they're starting to return again. You know, to quote at one of the recent webinars I was on, bonds are back, baby. So I just want to go ahead and share some of that. And the last comment I wanted to make about this, and I got a really good question from a client recently. So they made a comment about, hey, Mike, I know you weren't alive now, but during the 2000 to 2008, and yes, I was alive, I just wasn't as concerned about this at that point in time. There was a period called the lost decade. So we look at stocks, we talk about the long-term return of stocks, you know, being invested in that being really, you know, the bread and butter of creating a retirement scenario that can outlast even your own lives. How do you survive that? Looking at that last chart, bonds were up the entire period of that lost decade. That was the opportunity. That's the opportunity for retirees, why we get more conservatives, we get closer to retirement so that value is still there when we need it. So that chart is a wonderful illustration of what bonds can do. And at this point, bonds are about to get back to what they do best. And that is create a little bit of interest and hedge equity risk.
Which basically means protect you.
Thanks, Chris.
Yeah, you bet. So I want to spend another 30 minutes on this slide if we can, because I think I'm joking, it's super important. But I want to give you two things. Last year, it was said, I think maybe Howard Marks said it, it's the worst bond market since 1848. And for the 60% stock and 40% bond portfolio, according to some statistics, which I have from Deutsche Bank, it was by far the outlier since 1872 for the 60-40 portfolio for the worst return ever of a 60-40 portfolio. Why does it seem like it hasn't happened in a while? Because I know most of you weren't alive in 1876 or 1872, I'm sorry. At any rate, so that's a great one. How about S&P valuation measures? Maybe we'll hop to, Peter? Maybe we will. Well, there's a slide.
Sorry, my mouse is stuck. I'm getting in there.
No problem at all. No problem. So the S&P valuations are pretty interesting here. We won't beat you up too much with this, but there's a lot of great stuff we can learn from last year. Last year, there was a ton of fear. And you can see on the far right side of this graph, it showed that valuations actually came down significantly. Zach, I don't know if you want to touch on this slide.
Yeah, thank you, Chris. Just like you said, really interesting to pair this one with one that we'll show you in a little bit too, is along with investor confidence and how they kind of go back and forth with each other, actually inverse of each other amazingly when we look at that, and kind of with it mainly has to do with what media shares with us and how they make us feel during a lot of these times. But we love looking at this one for just a little bit of perspective when the question comes, are things actually temporarily down? Are they temporarily trading at a discount compared to where they were previously? And when we look at 2019, we are right around the historical 25-year average of about 16 for the price to earnings ratio. COVID dramatically dropped it temporarily for about 1 month, and then things got extremely overvalued, especially in the technology and the large growth companies that Chris mentioned earlier as well. Then we went through really 2020 with phenomenal returns, 2021 with incredible returns as well. And then what we know last year, temporarily down around 20%, and we're right along the long-term historical average for the markets. So the continuation of rebalancing during this as well, and we'll share a few other things with this one, is rebalancing is really to reduce risk. So when things get overvalued or rebalancing, you're trimming back of certain categories, and then rebuying ones that are temporarily down. So when things do correct themselves like they have historically and always have done, you don't have as big of a drop. If we were not to rebalance during these times when things were extremely overvalued, as you can see on the far right side of the chart from 2019 to 2021, this year, instead of a 10, 15, 20% temporary, depending on your strategy, might be down 30 or 40 because we would have been extremely overweight in those overvalued asset classes like technology and others. And if Peter, if you move on to the next slide as well, kind of to pair with it is just one thing that we always talk about as a timeless piece of our strategy is both having growth and value inside of the portfolio and the different asset classes. This just shows the relation of them to each other from growth to value. So if we're looking at the far left of the chart, when it's above the blue line, growth is trading at a higher value relative to value companies. And then from 2002 to 2018, really, value was the one that had a better current price to earnings ratio. And then we had the COVID peak from 2018 to 2022, and then where value is coming back into play this year as well. So rebalancing during all of these times help reduce risk, but also what we find is it actually can maximize returns as well.
Outstanding, thank you. But maybe also if the next slide, I think, gives us the second half returns after the decline. Zach, that might be your slide as well. I think you brought this one.
Yeah, this one was really interesting because this is May of 2022 that we took a look at this one. And we wanted to give historical perspective when we have a intra-year drop very quickly in the first half of the year. What does the second half perform as? As of May of 2022, the average decline, 24%. The average increase for the second half of the year was 27%, with a very large outlier during the Great Depression there as well. It was interesting when you looked at the chart that Ken went through for the annual end of the world, that the second half actually wasn't much better than the first half. But if we add one more month, the S&P 500 is actually up 8% to start this year, if we're rounding up a little bit. So just incredible to see on a 6 to 7 month, when the market temporarily drops 15%, it usually sets for good things moving forward.
Outstanding. Thank you, Zach. Thank you, Zach, as well. The next one actually shows us, and you've seen this before. It's a little bit hard for you to read unless you have glasses and you can zoom the screen out. But it's basically showing how typical corrections are. Each year, we have corrections of about 5% or more. They typically last 40 days. They happen 3 times a year. So the last occurrence, it said, was October of 2020. But now as we go through this, if we looked at it through 2022, there were many days where we had 5% corrections or more, many times in the year 2022. Historically, though, every year or so, about every 16 months, we have a 10% correction or more. Every 3.25 years approximately, we have 15% correction or more, and 20% or more, like last year, about every 5.5 years, or every 330. Average length is about 339 days. Just giving you a sample of how consistent these are. But when you take a look at them, they're natural and they're super healthy for a market as well. Next one shows maybe the time and volatility. This is in your slide program that you normally have at the back of your appointments. But as Vince Lombardi said, the fundamentals are really super important. So on this one here, just a couple of things of note. Maybe I can even have Ken or Zach run through 1 or 2 points on this. But I'm going to say when you look to the far right, it's showing you that the lowest risk long-term is in stocks. As you look at this will be updated through this year, last year as well, through 2022. And you're going to see that the single worst year for bonds on the far left, which was 6% before, is now 13%. So you're going to see this updated. What still is interesting is the 5-year rolling periods. You're going to find the 5-year rolling period stocks and bonds have almost exactly the same risk. That was not something you were taught in economics. So wonderful slide, just updated for 2022 with some interesting additions to that slide.
Chris, I think you bring up a good point there with that slide. If you go to the far right, we talk about retirement and, how can we bring this information to your retirement scenario, right? When we look at this, retirement's not a 1-year event. I mean, sometimes it is, we retire and go back to work. That's a 1-year event. But for the most part, if you decide to retire and stay in retirement, it's a 20, 30, maybe even a 40-year event, So when we look at this and we go to that right-hand side of that slide under the 20-year rolling period, like Chris alluded to, you can see that the green bar that you see there is a portfolio of great companies and stocks. And that, in a worst case scenario has averaged 6% per year for those 20 years. That's really what that means. And that gives us a lot of hope, because what that means is that if we're advocating a 4% annual withdrawal out of your bucket of money for income, that we wanted to make sure we go up over time in your retirement. Look at this. If we can, if stocks are doing 6% and we're taking out 4%, we're ahead. Now, not all of us are all in the stock market come retirement time, because we have bonds, like Mike said, to provide income and safety and protect you, like Chris said there. But the blue bar, if we're all in bonds, if we get too conservative, I've heard this before. The closer I get to retirement, I should get more conservative. I should have my age in bonds. We've heard these these myths before. And if you do that, look at it. If we go through a tough time in bonds, which we're going through right now, well, the opportunity's there, but we just went through a tough time with bonds, which is the blue bar. If we only earn 1% on our money for 20 years and we're taking out 4%, we're in trouble. That's why we need to blend these together so nicely. And that's the strategies and how we blend this together to provide you the income that you need for in retirement for a 20, 30-year retirement.
Awesome. Thank you as well. The next one is updated as well. Zach, was there anything you want to say on that one?
Absolutely. This is one of my favorite charts to go through, which is just showing the average length of a bull market versus a bear market. And really just for very simple purposes, really for the upturn market, the bull side lasts on average 4.4 years with an average total return of 155%. The average bear market lasts about 11 months with a cumulative temporary loss of around 31%. So really, when we look at that, it isn't participating in the downturn that is detrimental to a long-term plan. It's missing and not being part of the upturn. So that's really the timeless piece of not trying to time the market or when these can be forecast. If we're just looking back over the recent term and looking at from 2007, let's say, to 2022 on this chart, this is as of September of 2022. So when we're looking at this, we had really, besides the tiny little 1 month bear market that we had during COVID after things recovered, we really almost had a 13, 14 year bull market, which would be the longest really ever besides the 90s. So when we looked at that, we're actually towards the farther end of the average of the 11 months. If we're looking at it right now, even with the January that we had, we're about 13 months into this bear market. So when we look at the timeless pieces of it and everything that we combine together, history would tell us that we're farther through it than we are at the beginning, but even then we don't know as well. This could increase the average over time too, which is adding a little bit of perspective going back to the 1940s with average bull and bear markets.
Thank you, Zach. Appreciate that as well. Hey, one thing I want to for all of you who are on the actual program right now who haven't fallen asleep, I did hear a couple of heads hit the desk during some of the economic discussions. We'll go through a bit more of that. But what I want to do is remember the bottom right corner, you can ask questions. If there's really, really tough questions, feel free to put them in there and I'll have Ken or Zach answer those. I'll take the layups, which is a good one for me. But I do want to also kudos Lisa, who got me a calendar that's called 2023 Dad Jokes. So from time to time, I'll be pulling one of those out. I just wanted to show you it's a 2023 calendar of dad jokes, which I thought is good, because my favorite season is winter. It is way cooler than summer. You can use that one on your kids as well. But I think one of the best ones is, and many of you might have back injuries, as we get older, we have a lot of those as well, and I really am kind of skeptical of chiropractors. I didn't think my chiropractor could really correct my messed up posture, but I stand corrected. Again, you can use those, feel free. There's some good ones in there. Some really suck too. I know my wife right now has probably got her head in her hands going, don't use those, but I just wanted to make sure that I'll read you today's as well, because I think it's super important too, just for a little comic relief. Then we'll head back into the program. I have a friend who is always sweeping girls off their feet. He takes his job as a janitor very seriously. So anyway, you can see what our day usually starts with. It's a joke like that. And then I read the Bible and I read a few other books that are just of the day. But I wanted to share a few of those with you just so we could take a quick break from this. as we want to study three things that have just happened. One thing that you may want to take a look back is studying recessions. If many of you have been with us for 20 plus years, and you have for some of you, the past three recessions, I want to just do a quick discussion on. So let's hop onto the slide and I'll give a couple points. Really, we want to see if there's anything we can kind of look at and people say, oh, we knew that was coming. It's easy to armchair quarterback a recession after it's happened. But remember, you don't usually know they've happened until they've reported well after they've happened. This one's different. Everybody's been talking about this recession that may or may not happen for the entire year. What we want to do is offer a couple of different things. The very first one you see there is the 2001 through 2000. It's about 8 months during 2001, the recession. Peak unemployment maxed at about 6.3%, and that was in June of 2003. Look at how far that was after the recession that the unemployment peaked. Now, out of this recession, we were only able to knock off 0.3% for the decline in GDP. Now, the market was down 49% during that over the 1 year following this recession. And the pattern for the dot-com bubble, the 9/11 timeframe, is where we saw two of the biggest buildings in New York fall. The pattern here is that there was no pattern. There was nothing predictable in this. It was a very small recession. Now, let's take a look at the 2007, the center one, 2007 to 2009. We call that the financial crisis. And if you looked at it, that was a complete meltdown of the financial system like we hadn't seen since the 1930s. It was the longest of 18 months that we've had in the past 30 years or so, but it also met with a 57% correction in the prices temporarily of the S&P, only for the following 4 months, once it ended, to start shooting up dramatically at the end of the recession, which was kind of a crazy time frame. But once again, the pattern and comparing those two together, non-comparable. I'm going to show you something about the first two versus the last one in just a moment. But here, the second one, the one we had here, the third one, I should say, the one that is, I'm going to call it the COVID shutdown. You're going to see the largest GDP decline we had since the Great Depression, 19.2%. Peak unemployment, 14.7%. That was April 3 years ago almost. 14.7%. Mark that number. The duration was a paltry 2 months. The market fell 34% in 33 days. It fully recovered in 6 months, less 1 day. That was the fastest round trip we'd seen from bear to recovery with that quick of a GDP decline. Now, like you'd found as well, a 14.7% unemployment peak. Do you remember what I said at the beginning of the program? If you were paying attention, what is unemployment now? 3.4. We now have a problem where people who want work are scarce. We have 11 million job openings. So there's probably 2 to 3 jobs per seeker of work presently. Those who are being let go from the technology companies, which have been large numbers, they hadn't happened in many years, are now able to get jobs at other places very quickly in some of the massive startups that are occurring and have occurred over the last 5 and 10 years in Silicon Valley. So I guess that's a don't cry for me, Argentina. What I wanted to show you 2 things on here very quick and not to belabor the point, but of the first 2 recessions, those both happened during a secular bear market. Secular bear markets are reflected in times where there's more pain, the market's moving sideways or down, if you will. And they tend to be more protracted and more defined, actually larger corrections, if you will. So in the first 2, we're talking market corrections of 49 and 57%. The same kind of a recession or even greater in a secular bull market, like we are either having now or have been having. If you look at that, that's a incredible 19% correction last year, at one point down 25. You're noticing the difference. The general feeling is it's a bull market. So if you're looking at the 2, they're 2 different environments. One secular bear, much deeper corrections in price because of fear. The second one, being the February and even the one maybe we're talking about now, have a bit more optimism because they're in secular bull markets where cash is coming into the market and people are relatively optimistic longer term. I just wanted to point those out because we've talked about them before, and those are fairly important when it comes to perspective and how you look at it. I know that was a lot to really talk about those 3 recessions, but I wanted to compare the 3 because I got to tell you, from the 3, there is really no comparison. There's nothing between the three that's predictable per se. They're all different. The key is for us to keep asking the question, is it going to be a recession or not? There's going to be recession. Yes. The difference is we just don't know when. And it's a natural part of the bull market. So I wanted to compare those three and see if there was something we could learn about them. We learned that they're unpredictable. We learned that trying to live our lives predicting them is actually futile. It's not something that we here do. So we look at your plan and continue looking at the long term of how recessions fit into your plan, and they are built into your plan as well. So I wanted to go through a couple of those different ideas. There's another wonderful update that maybe I'll let Ken, Zach, or Mike share, which is the bumpy road to the long-term average. But before I get into that, thanks for bringing that up, Peter. I just wanted to bring those ideas up to you about the recessions. We've studied them. It's what we do here often. You don't need to, but I wanted to give you something. There's a lot more depth we study those with, but I wanted to give you at least some of the pieces that we have found that were valuable about those, and that they are unpredictable. We will continue to do planning as our major function, and these are part of the bigger picture as we go forward. Zach, Mike, anyone?
Yeah, thank you, Chris. I had to put this one in here. It's one of my favorite charts to go through, and it really just adds great perspective of kind of managing expectations of what the markets can do for us moving forward. Because we always hear that the long-term average of the stock market since 1930 is 10% per year, right? But this chart really shows us that it's a bumpy road to get to that average. And if we're looking all the way back to the far left to really modern day, we're at the 10% average, which is the gray bar, but it's only been within 2% of that 10% number. So it's really only been between 12 and 8% 6 times since 1930. So it's really well above, well below to equal that average long term. And this is one of my favorite ones to use with your children or grandchildren or anyone that's really just trying to become a better investor, because it really helps. Oh, we may not get 10% per year, but we may get 20 one year, -5 the other, so on and so forth. So this is one of our favorite ones to just show the timeless piece of how we get to those averages.
Thank you. Thank you. The next one shows us a bit that's super important, if you will, and that is consumer confidence. I often talk about this over time, but it's not just consumer confidence, it's a fear factor. And if you take a look at this, the fear factor that occurred, if you will, during about October 13th or so of last year was as high or higher than it was during the pandemic, during the financial crisis. So you start to look at this, how in October are we lower than what occurred in 2009, 2010? Matter of fact, we didn't really, we eclipsed everything on this chart back into the 70s for fear. Why? What was it? Catastrophist media? Was it war? Was it inflation? Was it COVID worries? Was it that we had bad gas? I'm sorry, I should define that. Bad gas was the fact that last year, 2 months out of the 12, natural gas prices fell over 35%, and that hasn't happened in history. So as I go through, well, what was it? Oh, all these different things. It was probably all of them combined in some form, but this is what happens when we hit massive fear. So when you can see consumer sentiment way back on the back of the chart in the 70s, many of you remember the 70s and gas lines. You can go back into the early 80s as well, the kind of end of that recession. October and 90s in the center. And then really the two that probably hit the biggest were in 2009 and 2011. And then the worst consumer, really fear that we felt without massive market issues was last year in October. So remember that when things feel that bad, it really feels like, oh my gosh, is there any hope? And there always is hope. Great companies adjust. They will move on and move forward. So this is a great slide. We love this kind of stuff. It shows some wonderful points when it comes to that as well. Inflation. Ken, maybe would you like to talk about inflation? Ken, Mike, Zach?
Sure, that sounds good, Chris. Appreciate it. Yeah, what you're seeing here is inflation. You know what it is. We feel it right now. We can go through the numbers, which I think are interesting. And the headline CPIs over a 50-year average is 4%. But most recently, numbers are coming in at 7.1%. And you're also seeing interest rates right behind there as well. And the whole point there is that what the Fed is doing is they're trying to curb it. They're trying to slow down the idea of these rising prices going higher and higher and almost out of control in some categories, which I think we'll get to the next slide, at the grocery store especially. So, but people are still saying yes to things. People are still buying things. I think people right now, when I talk to them, I feel like people are starting to consider not buying something at this point in time because the price may be too high, or they're going to wait it out to see what happens. So that's an interesting piece there. But inflation is something we feel. We certainly know what's going on right now. And only time will tell to see if, what the Fed is doing, if it's the correct decision, if it's too harsh of a interest rate, if it's about right. We don't know that until hindsight comes into play. But the Fed did come out and say that this inflationary period right now, we're in that right now. So they're looking at the data. They're saying that it's coming down, but it's going to take time for that to come back into the markets, come back into our lives when it comes to products and things that we buy every day. There's always probably a decent lag behind all that. It just doesn't happen, as we snap our fingers like that. So.
And they're also saying, and I think along with it, and you've talked about this before, the massive disinflation that exists in technology, that is still on the march, and it's still a massive driver down of the overall cost of computing, the cost of getting things done. This is called the microprocessor decade. For instance, that semiconductor we're all talking about and have been talking about for 30, 40 years, we're going to see more semiconductors than ever produced as we're looking at the Internet of Things, a billion or several billion connected things. So they still need a lot of microprocessors in it. And these are deflationary. They're giving us more power at a lower price. But you know what really cures inflation? Inflation. Once you raise the price high enough, people stop buying it. Look at homes in Florida. Look at homes in Los Angeles. Look at expensive items, baseball cards. Look at Bitcoin. That's the prospect of human, kind of human speculation. Anyway, I just wanted to jump in with those. I know you mentioned it before, and those are super important as well.
Chris, one thing that we had come in, just speaking of inflation, was just what is your opinion of the State of the Union address? And last night was the first one that I've actually ever watched, pretty much start to finish. So I should go back and watch the other ones to have a little bit more perspective. Very interesting. And Chris, you might have a more elaborate opinion as well. One thing, I just got off essentially reading a bunch of different things about leadership, of being a better human, all the things that we go through here together, and then watched that and it was like, man, I really wish there was a lot of opportunities there from many different angles for someone to step up as a leader. And really just a saying that I heard during the, I think it was the memorial service in Washington, D.C. 3 or 4 years ago, which was just, let us not on what temporarily divides us, but rather what permanently unites us. So that's what kind of my takeaway from the State of the Union address. Sounds like there was a lot in there and a lot of different plans upcoming. But Chris, any opinions on it?
I'm going to give I don't bring it up on purpose because I think it's become more of a media ploy. It was intended to be something where we give what's going on with our great union and not really give opinion, but things we can possibly work on together. And it's turned into a few different things, not with this, but with other administrations as well. So I think it's changed to an outrage session, which we can be most outraged because now you got 17 different catastrophist media coverages afterward. Pick your tune. Did he say good things? Did he say bad things? You can find confirmation bias on either one. So I really don't like to talk a lot about that because I don't think it's necessarily as constructive as we need in our nation. So I tend to let it simmer away. Say a lot of things in there. I appreciate it. And I'm just going to say that I won't really render opinion on it. I don't think it's any more what it's began to be intended to be. I'll leave it at that. I saw the question and I actually appreciate it, but I did ignore it for a bit here on purpose just because I think it's become something we don't want it to be. Just my thought. So as we go in, Zach, thank you tremendously looking on the inflation as well. What I think we need to touch on now as we go through is just a couple of things with the consumer price index. Actually, some of the prices, I think, Ken, you did this one before, like what it is for different prices of food and different things as well. I think this was your idea before you brought it up last program.
Yeah, absolutely. I mean, if anytime we go to a restaurant, I can't remember the last time a hamburger and a fries now is costing maybe $14, $15, right? Salads are $15, $17. I mean, things are becoming more and more expensive. And, that really hurts a lot of families out there. Those who have families and, have jobs. And, when you look at this piece, eggs, that says plus 32%. I have four young kids with their mouths open pretty much every second of the day right now. And I can assure you that eggs are way more than 32% right now. I'm pretty sure that they might be closer to 100 to 150% based on where they were before. So these are just things, but you look at landscaping, you look at paints, you look at cars, homes, everything in our lives right now that we spend a lot of money on is costing more and more and more. And so that is something to be aware of. I think you all know that. I think you feel that. Some of you said, hey, you know what? We're not actually going, to the theaters and buying popcorn for $15. We're not doing that anymore. We're gonna hold off on until when that settles down. So that's a really interesting piece, but that's the cost of things getting more expensive, as we know. And until people shake their head no, we might see those prices for a little while now. But as long as people are saying yes to things, we're still going to see that. So.
Thank you, Ken. So we had another question. Do we think that the inflation was going to happen anyway from the 2020s, or was it something that occurred during the things that have happened in the 2020 correction? I'd say if you remember my discussion that we talked about a few times with Dr. Jeremy Siegel, he's the Wharton School professor, written a couple of great books. You'll actually find that when you put that much money in the M2 money supply, inflation is almost a forgiven and foregone conclusion. And we talked about it being about 5% per year over a 4-year period of time. Well, instead it was a 5, then a 10, and probably 5 happening in a very quick, rapid succession. So I guess the question, if you want to answer to it, it was probably due to some of the policies. Was it necessary? If you look at wage inflation and the fact of what it costs now to hire a human to do something, that's a portion that I think was probably inevitable, going from $5 to $15. But if you look at some of the policies, those were temporary items as well, that really pushed it ahead. But the hawkish Fed's entire year last year, remember dovish and hawkish. Dovish is very kind, will be very nice and keep rates low. Hawkish is they were attacking inflation as their sole reason for existence. So when you look at things like that, there were some things that happened. They decided to attack it. They also know the Fed was also part in some of the policies with the Fed in creating it. So I think it's a great question. Thank you for those as well. Again, we want to make the program more about what you want to know than just us sitting here as talking heads talking about slides. So thank you for the questions as well. Even if they're very, if the questions are very opinion based, we'll defer those and we'll push those off to maybe individual meetings. But thank you. There's some great questions coming through. I just wanted to address that one as well. The next one we want to talk a little bit about is, and this is something we've had a lot of conversations. I know Ken, myself, Zach, Mike, Peter as well, and a lot of our conversations is cash account returns. Take a look at this. First thing I want to do is take a stroll back down to memory lane in 1980. Do you remember when you could get a 6-month CD for 10.8%? A 10% 6-month CD. Who here would like to have that right now? It's a guaranteed 10%. I'm raising my hand if you couldn't tell. Now, to many of you, you remember those times, but that's when education inflation was 9%, medical inflation was 8.2%, housing inflation was 5.8%. That's all towards the left side. As you move to the 90s, that rate dropped to 5.4%, about half of that. What stayed high? Education inflation, 7.2%. Medical inflation, as we look at it, right around 5.3%. Those two stayed very high. Moving into the 2000s, it dropped even further to 3.3% for the 6-month CD versus inflation. Now you start to look at the headline inflation in the blue lines. Back in the 1980s, it was the light blue line. It was 5.5. In the 90s, as you take a gander again, it was 3.8. In the 2000s, it was 2.6. 2010, 1.8. CDs dropped to 0.5. We had a very accommodating Fed, very, very low interest rates from the issues that occurred in banking back in the 2008s and 9s. Still, our highest two inflators were education and medical. This year, once again, headline inflation actually peaked for the 2020s so far, 4.9% in this very short time that we've had in the 2020s. If you look at housing inflation, it's the first time that it's also led. What hasn't? Medical and education inflation, although they seem it, they have not. And so far, the average 6-month CD has been 0.4% until the Fed began to be very hawkish. So there's a few things I wanted to talk about this with, because there's a slide that actually we don't have in here that shows expectation versus reality. Rates have gone up significantly over the past, let's call it 6 months, especially. What are you still getting on your savings at the bank? On average, 0.3. There are some alternatives out there that people are just discovering, the 3.5% to 4% range, that are available in different strategies. There are some things out there. If you want to, there's Series I bonds, which actually the Fed has been talking about again. They're thinking about the rate might be 2.5. They were all the rage when they were 9.8. But with this inflation, remember, they go with current inflation rates. They may not be as good as you'd hoped in the past. Also, high yield savings accounts. There's different forms there. If I mention any names, they'll strike that from the record. So I'm not going to mention where they are. High yield money market funds, certificates of deposit with certain banks, and short-term treasury notes. Now, what I want to say, those are the 5 different forms there. But if you have some questions about those, seriously, give us a call on these, because we have some alternatives that are not locking you into long-term periods of time, but they give you rates that are wildly competitive as well. So it's something you want to discover. If you've got a lot of cash sitting outside, and I know a few of you do, if you want to turn, for instance, $50,000 into a $2,000 a year, potential interest versus $200, it's a potential reality right now when looking at these. And this is not something you've been, going along. This is what rates are. All of a sudden they've changed. So it's something worth looking at, especially on that super safe kind of short-term money that you have as well. Any questions or thoughts on that, Ken or Zach? No,
I think it's a great summary. I think the current rate of the I bonds, we got to ask that question recently. What is it? 6.89% is the current annualized rate. They always break it up into a couple categories throughout the year. I think the base rate is 0.4% on those I bonds right now. So 0.4, Mike just mentioned great corporate bonds, great bonds coming out with higher yields right now, 4, 5, and 6% is the market, if you will, right? So that's an interesting piece when inflation, and the Fed just says we have disinflationary pieces starting, we're going to start to see those I bonds probably come down. Again, that base rate is only 0.4%. So something to keep in mind. Inflation's still here, of course. So those rates are there. But just keep an eye on those pieces, because there all are alternatives to be looking at. And we certainly can help you out with those solutions.
One real quick thing, just to add real quick, Chris, is just be careful of different products that come out at this time as well. So we're always kind of scanning and looking for different things to protect, or what you might be seeing in newspapers or on TV or others. And one thing that we've seen often recently is just a lot of promises for fixed annuities, generally different ranges of rates, but also what are called equity indexed annuities as well, where they essentially promise a cap of 7 to maybe even 11%, and then minimal downside as well. Just be careful when analyzing or looking at these different products, where Chris mentioned the beauty of keeping things very liquid over the short term for some of these monies as well.
Yeah, they often have extremely high surrender periods and long surrender periods as well. So they're actually kind of detrimental to many. We often see them when people said, oops, I did this and I didn't realize. That's the case we mostly often see them. The next 2 slides, at risk of really getting ad nauseum on the Fed and interest rates, I'll just do them both super quick, and then we'll head to some of the ideas you could do with financing. But first, the Fed and interest rates. As you can see here, this is interest rates. If you go back into the 70s, in the middle of it, the rates were as high as, the nominal 10-year treasury as high as 16%. We'd love to all lock in our fixed income at 16%, maybe our whole portfolio guaranteed at 16%, like back in 1980 for a 30-year period of time, right? But if you go back, that's also when your mortgage rates, and looking at this, real yields were much lower because of inflation as well. As you can see on the far right, though, you're finding that right now, the true nominal yields right around 3.88% as of December. But you're finding after inflation, it's one of the lowest real yields we've ever seen. So people get excited, but with the 10% inflation rate, that actually takes away from what we've received as well. And the next one is really what the Fed funds target rate is. So the next slide just shows that, listen, the Fed has hawkishly raised rates. They may have gone up higher. They think that this time when the Fed raised a 1/4 point, that was a pretty exciting time. Also, when the World Economic Forum said that the emerging markets are open and running again, and we think that peak inflation has passed there. That's what they had said. We had a couple of really good days in the month of January. What I did want to emphasize about all of this is that you cannot time when to be in and out of the market. If you want proof of that, if you really want proof of that, just take a look at what happened in the month of January. You actually had an entire year's return in some categories in the month of January alone. So I want to bring that to your attention. Again, timing is almost impossible. People say, oh, I know it's going to happen. It's easy to say once it's happened. Like, I know who's going to win the Super Bowl the day after it happens, not before. So I wanted to go through some of those items as well. Thank you, Peter, for running through those couple of slides pretty quickly. The last one is really financing options. Ken or Mike, or Ken, Mike, I'm sorry, or Zach, if you guys want to just hit that one really quickly before we go into the financial planning section.
Yeah, I can touch on that one. Thank you, Chris. Yeah, financing options. We get a lot of questions on that. What to do with some home remodeling going around the house, or something that you're trying to do with a car, something like that. Cash on hand is looking pretty decent right now for financing. I know we're trying to earn a little more with these different alternatives with I-bonds and money market funds and enhanced money rates. When you look at this, home equity line of credit, to my knowledge right now, and I've talk to some clients that have them, they're creeping up into the 7s, maybe middle 7s right now. So that's becoming a little more expensive money. That used to be the go-to. We could usually get that for the introductory rate around 1.99 in some cases, maybe up to 4. But again, this is very much a specific thing to you, what you're trying to accomplish and what you're trying to finance. So maybe we do use the strategy, or here it says the portfolio, but we have to call it the strategy on these webinars. But we have to use the strategy. Securities-based lending is something we can basically use. If you have an investment account here, a non-IRA account, we can use that. Home equity lines of credit, and even our personal loan. But I think that cash on hand right now is going to be a good option for some of the financing going forward as of right now. Again, this could change, 6 months from now, and then the strategy and the advice will change as well. So.
Thank you very much, Ken. I appreciate that as well. So as we hit into the next section here, it's going to talk a little bit more about some of the financial planning items. There's really a whole lot of things that have gone on here with the Secure Act 2.0. Ed Slott recently came out and said it's overhyped. A lot of people are talking about a lot of the changes of it, but Ed gives us kind of a bigger picture item of what it looks like. And he said it's overhyped in a couple categories, but with that, there's still some changes that are very important for us to go through, which we'll address here. More importantly, I want to say in about 5 or 10 minutes, I'm going to give you one of the demonstrations of your life. It's been said, if you remember when electricity was invented, none of you were alive. Thomas Edison electrified a 20-block area of New York City with his own generator. This is the likening of that happening. I've talked about it 7 years ago, but I want to give you the implications of what artificial intelligence will do and maybe show you a demonstration if it's available, because it's super popular right now. If I can get in, I'm going to show you a demonstration of what artificial intelligence can do with chat.ai. So stay tuned with us. Get your coffee, finish your nap, whatever you need to do. But in about 10 minutes, we're going to go through that piece as well. In the financial planning here, Peter, if you can, I want to give you the 8 great mistakes of financial planning. I'm just going to read through them quick, but just so you know. Number 1 is not having a team assembled. Number 2 is not having an overall plan for retirement. Number 3 is not having or preparing an honest budget. And that's a very important one, an honest budget. Number 4 is projecting returns that are way too high. Number 5 is bad habits, many different forms when it comes to retirement. Number 6, not planning for the spouse that does not handle finances. What might they do if you're the first one to pass? Number 7, not making decisions while we still have the facilities to, or we're still able to mentally, such as, should I move here? Should I do, who gets that? Should I get rid of this? And number 8, more importantly, probably the thing that we've seen is lack of purpose. What do I do now that I've left the industry that I'm in? This is one of the most important parts of your plan. So these are the 8 great mistakes of retirement as we go through. I just wanted to hit on those. But with the Secure Act 2.0, there's some different items that we're going to go through here. The next slide just shows you the bigger picture of them. And then there's a couple. We'll hit on some of these because they're going to be very individual to you. But the planning items for the Secure Act 2.0, taking a look at rebalancing, some charitable giving, some Roth conversions, Social Security planning, income planning, healthcare planning. These are 7 major areas of planning that we look at for you. So these 7 are all important, but we want to give you just maybe 1 or 2 tips that are really highlighting each one of those, not go heavily into them and talk about them forever, but just give you, here's a couple of things you can take action on. I know you hire us to simplify your life. Sometimes we get in here, we get really excited about this. We can give a 7-hour seminar just on the Secure Act 2.0. That's not what you bring us on for. That's not what you're part of your team. So with that, I want to bring that to the Secure Act 2.0. Ken or Zach?
Yeah, I'll start with it, Zach. You can kind of piggyback as well here. So I'm going to hit some of the highlights that Chris said here. So we've talked about the Secure Act 2.0 quite a bit here. I'm going to try to bring down some things that are really relevant to your scenario that we see on an everyday basis. But the required minimum distribution age, as you can see the first bullet point there, the RMD, required minimum distribution age, increased in 2023 to age 73. Just remember, like a couple of years ago, this used to be 70 and a half. And now next thing you know, it was 72. Now it's 73. So they're delaying that, which is really great because it really widens the window for the planning that we do for you. You know, say you retire at 62, 65, whatever the age is that you retire in. When you retire to the age of 73 now, those are some really, really critical planning years that we focus on with you, as you probably know. If you retired with us, you know that those 5 or 6 or 7 years after retirement, we do a ton of planning for you when it comes to taxes and tax planning. So this is really helpful. Rothomania, it says Rothomania, Rothomania, I like it. It's a new term for mania, mania. I like that. So basically what's happening here is the Fed, the IRS basically wants everybody to do Roth version of whatever they're trying to accomplish, right? So we're starting to see SEP plans, SEP plans, some of you self-employed clients that have these, that's where it comes in. We actually can do Roth Simple, Roth SEP. These are all new things that have come out here this year in Secure Act 2.0. So we'll help you with that piece. It really comes down to the custodian actually acknowledging some of this as well. So we have to work with some of the custodians as well there as well with Raymond James. Rollovers from 529 plans. Again, I'm just going to touch on this. This one starts next year, but it was part of Secure Act 2.0. And any unused monies, we have a chance to get them into the beneficiary, which is typically the kids, into their own Roth IRAs. So there's some criteria we need to meet with that one. So it's not just, take the money from a 529 plan and roll it into the Roth. It's not as simple as that. We have to meet a couple criteria. We'll let you know what this stuff is when we talk with you as well. Increased catch-up contribution limits for our pre-retirees that are getting ready to retire. There's some great opportunities with actually more money being able to put into retirement plans, 401ks, IRAs. That's really what that means. And if we need to get the money out early for whatever reason, if there's a hardship we're going through, they've expanded some of those exceptions, and we'll help you out with those if that is your scenario as well. So that's the first piece on Secure Act 2.0.
Thank you, Ken. I appreciate that. How about Zach? Maybe can you touch on some of the charitable giving items? We have a lot of questions about those QCDs. Can I still do them? Did that age change, or just some of the basics of those as well?
Yeah, great point, Chris. That did not change. And in typical IRS fashion so far, things don't exactly line up in a logical fashion. Like Ken mentioned, it went from 70 and a half to 72 to now 73 or potentially even 75, depending on your age for those required minimum distributions. Qualified charitable distributions you still can do from starting at 70 and a half, and really just a way to give directly to charity from your IRA and have to pay zero taxes on those dollars going there. If charitable giving is important to you, there's other ways to do it as well, and strategies that we've been exploring over time. Donor advised funds are continuing to increase in popularity. Essentially a way that if, as an example, if you were to give $10,000 a year to a church or charity, you could bunch those together into 1 year and say, let's say bunch 5 years of those $50,000, you could put it in a donor advised fund in this year. You could take a deduction for those contributions and then gift it over time to those respective charities as well. You can set it up monthly, you can set them off on one-off, but you have a lot more control of it. So that's been an important one that's come up, especially towards the end of last year, to reduce some tax bills. Another one that if you had any low basis, if you bought stock at a very low amount and now it's a much higher amount at a higher value per share, you can actually give that stock directly to charity. You don't pay any taxes on those. If you really like that stock and the future growth of that company, you can actually rebuy into that stock at the higher and increase your average cost per share that you own it for. And then you still can give through cash as well. The double standard deduction is still there for a few more years. So if you itemize, maybe giving in cash actually makes more sense than the QCDs, the donor advised fund, or gifting through stock, still an option for you as well.
Thank you, Zach. Awesome. I appreciate that as well. Some of the ideas too we have about Roth conversions and Social Security planning. It's an interesting piece as well. If we go to the next one, just Roth conversions, converting prior to your RMD age, some of the different ideas while converting while you're in a low tax bracket. So what do we look for when we're doing this for you? We look to maximize your ability to reduce taxes. Another way that should be said is you have a certain tax burden. Our goal is to help you pay the least in tax that you can legally throughout your life. So Roth conversions is a massive strategy that we look at. So when we do it, it's converting prior to RMD age, required minimum distribution, converting when you're a low tax bracket, converting with a long time horizon, and also converting assets while the market is down. Those are three bigger categories that we tend to use with Roth conversions. How about the next one? Social Security planning, Ken or Zach, if you want to bring this up.
Yeah, Social Security plan. We get a lot of questions on this with our pre-retirees, those who are about to retire with us. For those who have already retired, you know how this works, but we do have a fair amount of clients that are getting ready to retire with us as well pretty soon as well. So when do you file? Typically about 3 months before you really want to start your benefit. There's a little bit of a lag time. It can happen quicker than that, but everything has to be in good order. The Social Security Administration, the offices have to be up to speed with enough manpower and working power there to actually take the appointments with all the people coming in. But typically 3 months in advance is a good time to start that piece, if you will. The second piece there is, when am I going to get my check? When is it going to show up in my checking account? And this has everything to do, it's a very technical thing they've come up with. It has everything to do with the day of your birthday. So if you have a birthday between 1 and 10, you're going to get it on the second Wednesday of every month. If it's between 11 and 20, you're going to get it on the third Wednesday of every month. If it's 21 to 31, you're going to get it on the fourth Wednesday of every month. So that's when you're going to get your check. It's going to show up. How is it taxed? That's a complicated formula. There's 3 or 4 pieces that go into it. It talks about overall income, half of your benefit plus non-taxable interest. They come up with this formula to say, okay, how much of this benefit is going to be taxed? Sometimes it's 0, sometimes it's 50%, sometimes it's 85% of your benefit that gets included from a taxability standpoint. All depends on how much other income you have. And this is something we factor in when, remember, Chris was talking about Roth conversion planning. So Roth conversion planning is adding more income to your scenario, reportable income, which is just fine. There's all this stuff parlays together with Medicare planning, with Social Security planning here. So we're very aware of these pieces, and not to have you jump up and all of a sudden we're paying excess Medicare premiums for no reason, or Social Security taxes that weren't necessarily needed as well. So the filing strategies, they're pretty straightforward right now. There used to be many different ways to do all these with file and suspend. But basically, you have to be filing, you have to be taking your benefit for spousal benefits to kick in and things of that nature. So again, we'll help you with that. That one's very much a per person type of scenario there. So we'll help you with that. Working while on Social Security, this is a big one. We get a lot of questions on this one, is how much can we make if we're taking Social Security? And the big one here is, if you start taking Social Security before your full retirement age, which can be 66 in a few months. For a lot of us, it's 67 for full retirement age. This comes into play because you only can make so much while taking Social Security before full retirement age. And that number for 2023 is $21,240 that we can earn while on Social Security. But if we earn more than that, then our benefits are going to start getting reduced, and they get reduced dramatically and quickly. So we just need to be aware of, when we're going to retire. Are we going to work part-time? Are we going to fully retire? What's our plan? And that also helps us determine, when the best time to take Social Security is going to be as well. Survivorship benefits, it's a tender topic. Some people call this the widower's benefit or the widow's benefit that you hear out there. Again, this is a tender topic. Our biggest calling is to help you with your scenario. If a spouse does pass away, if that's your situation, we will certainly be there for you. It's our biggest calling. You've hired us. We will be there when it counts the most. We will be there when you need to make some of the biggest decisions that we need to make. as far as that goes, we will be there for you. We will help you optimize all this during that tender time and that grieving period that you're going through. So that's what survivorhood benefits are all about.
Thank you, Ken. I appreciate that. Some of the healthcare planning that we do as well, Zach, you just want to hit some of those real quick before I hop over to Mike?
Yeah, definitely. And this is one of the extreme advantages of using those centers of influence that we mentioned at the beginning of the program. We're always meeting with health insurance specialists and all these people in these different categories to bring up better ideas for you as well. And really with healthcare planning, there's always constant changes with Medicare and which exactly plan to choose that's suitable for you. So that would be a meeting with a health insurance specialist, which we have those that we're constantly interviewing and screening. You have COBRA still as an option that if you were to retire before your age 65, you can actually extend your health insurance for an extended period of time, usually around 12 to 18 months. You have your employer plan that may offer benefits and still the marketplace with subsidies. And really it could be a whole segment of how we can do that to potentially reduce income, to look at our insurance premiums and others. But really, if we're planning on retiring before age 65, it's a huge item that we take a look at for you as well in the overall grand scheme of things.
Thank you very much. I appreciate the one, like also Zach said, is Medicare, which is IRMA. That's if you make too much money, you have a higher premium in several categories. What's interesting is I met with a prospect yesterday and he said, I've done this most of myself. So I made the investment decisions, and really he kind of viewed that's what it was all about. Once we started talking about what it really is about, he said, oh my gosh, I wasn't even considering 90% of what you taught, 99% of what you talked about. So thank you for bringing those up. Those are outstanding as well. The next one, I know there's some unwritten rules of retirement, and there they are. Just wanted to make sure you guys saw those. I'll retire that slide. I know it's funny to me, and that's why I keep bringing it up. So I wanted to make sure you knew those. Those right there are the 4 most important unwritten rules of retirement. Any order to you that's important, that's how you should use them and view them. At any rate, one thing I did skip over earlier, and that's the great work that Mike and Ryan are doing in a lot of the category of talking to our mutual fund wholesalers. So I wanted to have him give us a brief summary of what's been going on there. You'll see some written things coming out for our investment committee as well, but I wanted to have Mike give you just a quick update right now while on there before we head into the preview of the spring forum, which is talking about how artificial intelligence may blow us all away. I'm just kidding in that sense, but Mike, why don't you bring us an idea here, please? Bring us some ideas of what you guys are working on.
Yeah, thanks, Chris. And, this kind of comes back to everything that we do behind the scenes at the end of the day. When we talk about all of the different planning ideas that we just went through, all the ed slot stuff, that's time that we take to make sure that we can bring you the most up-to-date information. And we're really grateful to have that opportunity to be able to do those things. And likewise, talking to our partners and different mutual fund wholesalers and just attending these webinars and having the opportunity to do so, we've learned a lot of different things about the market. So far I've had within the last 2 weeks, even about 11 conversations with some of our partners, and I have 5 scheduled for Friday coming up here. So it's always going, it keeps turning. We're not just doing these things in immediate, preparation for these kind of discussions. But before Chris gives you the preview for the spring forum, some of the things that we've heard and some of the trends that are kind of going on, and just some of the things are really, really exciting within the market in general. And I mean, I'm always excited about what's going on with the market. So, but that being said, some of the trends, and we've talked about inflation a lot today, and truly, everybody's kind of in the consensus in the party saying that it's peaked, and that very well could be. Inflation's expected to kind of close out the year between 2 and 3%, could be up as 4, but that 2 to 3% is still a little bit higher than what it's been long term. And that being said, inflation is going to be a little bit sticky. What people are thinking is that not necessarily supply chain issues. Supply chain's kind of been working itself out. We don't hear about boats being parked outside of California or anything like that anymore. And to allude to the question that was asked earlier, those are some of the other things that we're adding to it. People able to spend money and then not have the supply or the available manpower to be able to go through that. But with supply chain working itself out, one of the biggest inflation pushers is going to be the growth of wages. And wages is also going to be a very interesting impact on earnings for different companies, because when you pay more, that's less profit margin, different things like that. So lots of salary increases over the last year, and we'll see how that affects things. Another hot topic conversation, housing market. it's anticipated the housing market's going to fall a little bit, maybe 7 to 10%. So what does that mean to anybody? Really, because of the leverage that isn't existing as it did in 2008, it's not going to be the same kind of crash there. But if you're thinking about buying a house, it might be an opportunity to wait a little bit. So, and then finally, just some of the other things that we've heard, I've already brought up bonds are back, different things like that, exciting with what we've done with the portfolio, things working going forward. And just the different things when we have conversations specific about the holdings that we have. There's a lot of different strategies underneath the hood of, the 13 core funds that we typically recommend depending on whatever the different strategy is, whether it's a mutual fund that invests specifically in companies where the owner is still an employee, or it has an algorithmic rebalancing technique that caters towards momentum. Different things from that regard, those are all things that we look at, and beyond diversifying sectors, we're diversifying within the actual strategies that exist there. So if anybody ever wants to get into the weeds, I'm happy to jump on a call, talk about some of those things. We're always available to do so. Thanks, Chris.
Mike lives in the weeds for us, which is great. We appreciate him doing so. And Ryan as well. Thank you guys so much for really taking all the time and getting some of the very important things that we need to make decisions on the portfolios and strategies that we all do in our investment committee. So the next section I want to go into here, you may just need to take a breath for a moment, shake out, be ready, because we talked about this 7 years ago. It started in 2015, if you will. In 2015, I was at Abundance 360 and they put 6,000 images up on screen, all different colors. And then they asked an artificial intelligence, whatever the heck that meant, to sort them. So for the entire day, we're sitting there and that's cool. And you can see it's moving things around and it sorted 7,000 pictures into 6 different color groups by the end of the day. And that was pretty amazing to us at the time. We're like, oh, that's incredible. What the heck do you do with that? But what's interesting is that was the beginning of there being no humans involved whatsoever in the process, simply computers sorting it. That was a nescient, the very kind of birthing process of what artificial intelligence does or did. Today, I'm not sure if many of you have heard of it, but chat.gpt. Artificial intelligence has now just crossed this knee of a curve where it's simple to use. You simply ask it a text-based question, and it can do things such as paint you a picture. The one I'm going to show you is text-based, and it can write things such as text papers. In the first 5 days of the introduction of this, it had over 5 million subscribers in the first 5 days. That's why oftentimes when you try to get on now, it says, chat.gpt is currently over demand. You can't get in right now. We'll let you know when it's available. But when you look at what it is a radical language. It just passed 4 of the advanced classes for law at the University of Minnesota and also Wharton School. Now it got a C+ grade, so it's about an average student, but this did this without a single human mind, simply asking it the questions for law school. It writes contracts. There is massive change coming on a forward basis for this. It's another step up or step back for humanity. We'll take a look at that here. I want to basically talk a little bit more about that as we go through. We'll talk more about this also at the forum coming up. Now, the forum that I normally have for technology will occur this year in the summer or late spring because they've moved the program to April from January. The good news is they're going to have it this year. We're having a bunch of incredible people, but this is now going to be firmly in the crosshairs of what we're talking about. What I'd like to try to do right now is share, if I may, my chat.gpt here. So can any of you see this? All I need is a yes or no. So I'm going to ask a question here. All this simply is I'm going to ask a question. What is AI? It is generating this as you see it right now. So artificial intelligence refers to the simulation of human intelligence in machines that are designed to think and act like humans. These machines can perform tasks that normally require human intelligence, such as visual perception, speech recognition, decision-making, and language translation. AI can be designed to learn and improve over time and use in its various applications, such as virtual assistants, self-driving cars, medical diagnoses, fraud protection, among others. So here's one sample. Write a poem. Oops. Actually, let's do this, right? And I'm just putting this on now, a song about AI. Verse 1, we've created a mind, not of flesh and bone, but of circuits and code. It's all on its own. It can learn and adapt with each passing day, a new way of thinking in a world far away. Here's the chorus. AI, our creation, a marvel to see, a being of intelligence beyond you and me, a symbol of progress, a new kind of art, a machine that can think with a mind of its own heart. So interesting. This is actually creating this song right now as you're seeing it. This here takes about 60 seconds or so with several bridges. But what happens when it becomes too much, when our creation becomes a force to be touched, a new kind of power that we can't control, a future uncertain, with a toll on its soul. I mean, this is interesting. It wrote this itself. So the outro, AI, the future is yours to decide. Will it be a blessing or a curse to abide? We've created a mind, not of flesh and bone, but of circuits and code. It's all on its own. This is now something I can ask iterative forms. So I can put in here, how can AI help us? This is about to list probably 7 different items. I asked it earlier. It can help us in healthcare. AI can help healthcare providers improve patient outcomes. Environmental protection. This is what it said before. We'll see if it comes out. There we go. It comes out with very similar. I can actually ask it now to improve itself and do it more intellectually or be more complex in its answer. I can ask it to write a 27-page term paper. I can do almost anything. The key with this now, I wanted to show you this here. I wanted to show you in real time what it creates, because you now have this as an ability. Maybe you don't have to think the rote thoughts you had. Maybe it allows human beings to begin to think on a secondary level, or more importantly, step back and go, what's really important to me? Family, relationships, and experiences. Is writing term papers a very important part of your life? Maybe it is if you're a college student, maybe not to us. What artificial intelligence can do here: improving healthcare, enhancing education, automating tasks, things that are repetitive, things that repeat themselves, things that are done over and over again. Wait, that's me, sorry. Improving efficiencies, transforming industries, such as transportation, finance, manufacturing, improving safety. AI can help prevent accidents, such as self-driving cars, facilitating research, and much more. However, it's important to note, AI presents challenges and potential risks, such as job displacement, privacy, and concerns. So if you start to look at this, similar to electricity, in the enlightenment that it gave us, you can now read at night, other than by candle, and not burn down your home, right? This is very similar in what it can do. You can now do mundane rote tasks. You can write a poem for your best friend. You can ask, there's another one here called DALL-E, that DALLE, that through OpenAI, this company here is called OpenAI, 375 employees. This is free to use if you can get on. Right now, Google is scrambling to come out with theirs as well. They have a massive investment in AI. This here was just put out about a month and a half ago, if you will, and accepted massively, very quickly. So now Google's coming out with their own language. You're going to see competing versions of AI that are now simple to use, in the sense that I ask it to do something, I tell it to do something, and you've heard of something called Jarvis. This may be the thinking behind what may allow you to have a virtual assistant. Hey, go ahead and book me the best plane ticket from Chicago to, Miami on this date. Would you prefer that, first class, this, aisle, window? And it'll automatically know those for you and tell you and know your preferences. It's a very, very interesting technology. And to give you an idea, it will freak you out for a bit. You will look at it and go, oh my goodness. This is something, as I looked at, and I think when you teach people about AI, the basics of its history, what it does, it's a neural network. They have 3 trillion lines of code that are enhanced and chosen as a way to simply put words together so that you and I as human beings can see them and we can understand them. They can be helpful to us. So it's a learning language, iterative. It learns from its own processes in here as well. But it's very interesting to look at the history of the algorithms inside of it. And it's really made available by the processing power and the increased processing power of computers. As semiconductors get faster and faster, as NVIDIA makes, well, that's one of the companies, as well as Intel and many of us, that make chips for this industry. it's incredible to take a look at what can happen with iterative AI. So somebody in here had a question, Larry Mattioli, sorry, need to leave now, but they tried to get into Chat GPT for 3 days, overloaded. How did I manage to get in? I have a special code to get in because I'm one of the creators of it. I'm joking. It's just time. You do it at some time and you stay in. But I was very fortunate to get in here after trying for about 2 hours while doing some research this morning. It is very difficult to get into some of these programs as well, simply because when you're doing them, they're very popular. So other people's have tried to do it. Other people tried to, I should say. So in this one here, I just wanted to say questions you want to ask in AI. Anybody have a question you want me to ask?
About something about retirement.
Okay. What is it? What do you want to ask about retirement? Something specific?
Poem about retirement.
Say it again, poem.
Yeah, poem about retirement.
You don't even have to spell it correctly, by the way. It'll find it. Retirement, the end of a chapter, the start of a new phase, a time to reflect on a lifetime of days, a career now ending, a new path ahead, with memories and moments that will never be shed. No more early mornings or late nights at work. No more deadlines or endless reports to perk. A chance to relax, to pursue your dreams, to travel the world and fulfill all your schemes. It's a time for laughter, for joy and peace, to cherish relationships, create new release, for hobbies and interests that were put on hold, now a chance to pursue what once was untold. So embrace this new journey with open arms wide and make the most of each moment with laughter and pride. For retirement is a gift that we've earned with our toil, a chance to live life with a brand new boil. So cherish each sunrise and savor each night and reveal or revel in the freedom of making life bright. For retirement is a chance to live life anew, to be grateful for the past and embrace what's yet to come into view. Not bad. I could probably do a little better, but you know, it's learning. It's learning. So this here should freak you out a little bit. There's incredible things you can do with this. There's a gentleman actually in the state of North Carolina that asked it to write a 6-year lease on a property with 8 continuous 1-year additions if somebody wanted them as well, and it was able to write that. So you're going to find a lot of times even those law. Another one is if you have a very similar AI for taxes, if you feed your taxes in, spits out perfect tax returns, right? There's a lot of different potential uses in this. It's a question of this has been democratized. They could charge us $50 or $70 a month to use it, right? Right now, they're putting it out for us just to use to test it and see how good it is. And for us to help them make it better, they're using us as the crowd to make this better. It's a really interesting idea. It's a great piece. If you want to write something, for instance, on inheriting money, something we've talked about a lot lately, there'll be articles that can come out. It can also be like a nice outline for you to be able to add human to some of the different pictures and ideas that you've talked about. But here's what I want to make sure you understand. Your children, your grandchildren will be on this well before you. Now you will, I'm giving you the advantage of jumping on this now. You can put all sorts of different questions into here, like here, will AI, what is it going to see? Kill humanity, or you know, will it end humanity? End humans. Let's look at that. See what it says. No, AI is not likely to end humanity. While AI has the potential to bring about significant changes and disruptions in society, it's highly unlikely to result in the extinction of humanity. I mean, these are the kind of questions you go through and ask, and it will give you smarter answers, even if you ask it. Additionally, AI can have numerous positive effects. So as long as we have a positive chain on this, and we can actually pull a plug on it, it's pretty incredible. But you can ask these kind of questions all day long. You can write reports. I came in one day about 4 weeks ago and I'd written 9 articles for the team, and they're like, oh my gosh, Chris is really inspired. I wrote 3 songs and a couple of poems. It took me about 7 minutes to do all of them. And I brought them in and it really told nobody whatsoever that I had done that. And it was just kind of fun to see what they thought. And it looks like a human is really productive, right? So there's a lot that this brings into thing, and you're going to get a chance now to think about it, how to use it. You're going to get a chance at chat.gpt. You need to get a login. Oh, here is chat dot GPT safe to use. That's what somebody asked me. Yes, OpenAI's chat.gpt3, which includes chat GPT model, is considered to be safe to use. OpenAI has implemented measures to ensure that the model is used with ethical and responsible manner and to minimize risk of harm. However, like any technology, there's always a potential for unintended consequences. So it's answering the question about itself. And now it's going to be iterative. If it's a good answer, I can click right below it and say, yep, that was a good answer. And on the far right side of the screen over here, I can actually say, nope, can you regenerate a response? And it will. So at any rate, I wanted to end with this because this is one of the 20 technologies that are going to disrupt the world. It's not just this. If you wanted to see, we had a slide that showed you chat.gpt and all the mannerisms, how it works. I don't necessarily need to do that. But what I wanted to do is show you this actual technology. Have you guys found, is this helpful? Is this neat to see? It's something I've been introduced for a long time. I've known OpenAI for a long time. I've been bringing this up to you, but until you see it in action, you often don't believe it or you've passed it by. I've had people recently say, hey, Chris, look what I found. Well, we talked about this 7 years ago and 6 and 5 and 4, but like it's until you buy a red car, you don't really see many red cars. Then you buy and talk about a red car and guess what? There it is. But this here, if you want to write, for instance, one thing I did is write a jingle, write an ad for, X, Y, or Z. It's kind of crazy to look at, but you can, here, how about, I'm just going to do this, right? An ad for a stump drilling service. See what it does. Oh my goodness, right? Tired of unsightly stumps marring the beauty of your lawn? Want to reclaim your yard? I mean, look at this. This is essentially writing for one of our clients, his next marketing piece. You're welcome, Mike. Anyhow, I wanted to show you how this works. I mean, this is pretty amazing, right? This is, what are the uses of this? You can choose. This is a gift I give you just of introduction, but being your guide, this is why I've been going to Abundance 360, because there are technologies like this that are going to change the very fabric of your family. They're going to change the very fabric of education. They're going to change the very fabric of who we are. And this is just one of 20 or so others. Material sciences, 3D printing, there's so many that are going on. I just want to go through and say, for you guys, hopefully this was helpful. So we have a poll out there, and was this helpful? And there's 2 answers, yes, very, and then no. So out of you so far, 13 of 13 that have answered have said yes, very. I probably should ask another question, does this freak you out? But this is a good one. There are so many possibilities, and this is, Ken always likes to say there's a fine line. There's a fine line with artificial intelligence between ethical use and proper use. And it also can be like social media. You can ask it questions and just waste your day away, right? But this can be very helpful. Hey, help me write an obituary. Hey, help me write a eulogy to my grandfather. I wrote a poem to my grandfather on this, and it made me actually tear up as if I had written it. So I don't think there's so much, this is human created, right? This is the next stage of humanity, is going to be human and machine interface. This isn't going to be something where it's going to, rise up and kill us. At some point, that's always a possibility, but other people may, kill other people. And there's some incredible things happening in the world as well. Today, we could have a quick moment of silence too for those who are in the Syria and Turkey area for this incredibly horrible, earthquake that happened that we now know about immediately. And I want to say, prayer to the families that are searching for others there as well. We can send a little prayer and good that way. That would be phenomenal too. But artificial intelligence, drone technologies can help search and find people. They can help keep people warm. They can find people in an avalanche. Technology is coming to be a savior of humans as much as it is to maybe put some different obstacles in their life. I want to tell you this because when we go to this Abundance 360, it's about all the great things that technology can do. I bring a filter in that says it's not just that. It's also what harm might it have? So there's a question. I've paid thousands of dollars for someone to do this for me. Is this a statement for Mike on the stump drilling? But now you have the answers. Hopefully you took a picture of that, Mike. I can get you that if not. But what advice can you give about investing in AI or other disrupting technologies? I can't give advice on it online right now on this recording, because if I do, they'll strike it. So if you have questions on it, you can talk to us. It's part of what we do. But due to SEC regulations and all, we cannot give you advanced recommendations on what companies there may be. There are several that have invested massively in this. This one you're talking about is a private company, not very investable, but a few other companies are working on technologies like this. There might be ways to play this kind of technology. This is game changing for you as a teacher, for you as a parent, for you as a grandparent, for us as humans. It's very exciting and also very concerning all at the same time. With that, I'll continue to go out and find things such as this to demonstrate, to send to you. Some of you have already known this, some of you have seen it when it came out, but many of you hadn't. But these are the kind of technologies I want you to be aware of so you can use them before they completely disrupt you. With that, signing off, this has not really been Chris. This has been an avatar of Chris during the entire presentation. I haven't actually been here. This is something I've recorded previously, and it's come up with the entire time we've been talking. So I just wanted to freak you out a little farther, is no longer that. Here, just a moment. Let me shut down my machine here. Oh, okay, now it's really me. Yeah, so now it's really me and I'm here. Just wanted to show you that this is really me here, and it's so far on the previous section hasn't been. So all those things when I was repeating the words like if you will and as well, that was not really me. That was just a recorded program. So without that, I wanted to say thank you tremendously for today. Petey can bring up the last slide, which is our entire team here. There is our entire team here to help you, less one who will be here on Friday, if you will. We will have a 13th joining us. And I wanted to say thank you for all of us. We spend our time doing this because of and with you. Any questions you have about anything, we know technology we've just shown you isn't necessarily our focus, but I got to tell you, it's one of the things that are most importantly going to affect both investments, our personal life, our relationships, our communities. It's going to give us a chance in many cases to get closer to all the things that are more important to us. So reflecting on what's important to us will be an important part of our conversations. Some of the next things I'll be adding to the presentation on a consistent basis is an AGB, always getting better section, which is more about being a better human. Maybe from a book, from some expert, but I'm going to give a section of 2 or 3 slides on things that we can do to be better versions of ourselves. Because I think in the future, being better humans is going to be super important when artificial intelligence can do a lot of the things we used to hang a lot of value on. So with technology, you can go ahead and scan this QR code if you want to give us some feedback as well. We'd love to see that. Hopefully this was beneficial to you. The next presentation is going to be written all by artificial intelligence. So we won't have to do anything other than sit here and smile. Maybe I'll even talk. We don't know. But I wanted to give you this codes, and from our team to you, we're Gentian here. Our focus is retirement. We want to help you plan it, live it, give it, and we're finding more importantly too recently is inherit it from your parents. We're here to help you in any situation that we can. When it comes to health and wellness, or if it comes to your well-being, we understand money is simply a resource for what's important to you. We get that. Please keep sharing that with us as well. And most importantly, thank you so much for your trust, you sending your friends to talk to us and your family as well. We appreciate that. That keeps us growing and healthy. And we want to make sure that we keep you growing and healthy as well. With that, I want to thank you from the team. We're all waving right now if we can. If anybody's on camera here, you can actually turn your mute off if you want to and say hello to everyone or say goodbye to everyone. But this team right here is what does it. I simply was somebody who was fortunate enough for them to want to work with me, but they are what make you special and win the awards. I want to make sure that they know that.
Appreciate it. Thank you very much, everybody.
Thanks, everyone.
Thank you, everybody.
Have a great day.
See you later. Thank you for joining us.